Tulip bulbs once sold for more than houses. Internet companies with no profit were once worth billions. And people once believed home prices could never fall. Each of these was a bubble, and each one eventually burst, wiping out fortunes in the process. So, what actually is a bubble? Why do smart, rational people keep falling for the same pattern over and over again, across centuries and completely different markets? Let's break down how a bubble actually forms and the warning signs that show up almost every single time. At its core, a bubble happens when the price of something rises far beyond what it's actually worth, driven not by real value, but by the belief that prices will keep going up. It's not just something going up in price. Growth alone isn't a bubble. What makes it a bubble is when people start buying not because they believe in the underlying value, but because they expect to sell to someone else at an even higher price later. Economists call this the greater fool mindset. You don't need to be right about the value, you just need someone else, a greater fool, willing to pay more than you did. Bubbles tend to follow a similar pattern, no matter what's inflating. First, there's a real, genuine reason for excitement, a new technology, a new market, a real innovation. This is called the displacement phase. Then comes the boom, where early investors make real money and news of their success attracts more buyers. As prices climb, a kind of collective euphoria takes over. People who were skeptical start jumping in, afraid of missing out. Media coverage increases. Ordinary people who've never invested before start participating, often borrowing money to buy in. At the peak, prices become completely disconnected from any reasonable estimate of real value, but very few people want to admit that, because everyone around them is still making money. You might assume experienced investors would recognize a bubble and avoid it, but history shows even professionals get caught up. Part of this is social. When everyone around you is getting rich off something, standing on the sidelines feels like a costly mistake, even if your instincts say the price is unreasonable. There's also a timing problem. Even investors who correctly identify a bubble often try to ride it a little longer, planning to sell right before it bursts. But bubbles don't announce their peak in advance, and by the time everyone tries to sell at once, prices can collapse far faster than they rose. While every bubble looks a little different, a few warning signs tend to repeat. Rapid price increases with no clear connection to underlying earnings or value. A surge in first-time or inexperienced investors entering the market. Widespread borrowing to buy in, since people who use debt to invest amplify both gains and losses. And a general sense that this time is different, a phrase that shows up in nearly every bubble in history, right before the ones that followed the same old pattern anyway. Bubbles keep happening because the underlying psychology never really changes, even as the specific market does. Next time, we'll look at one of the most famous examples in modern history, the dot-com bubble, where excitement over the internet sent stock prices soaring before wiping out trillions of dollars almost overnight. If this helped make sense of how bubbles work, subscribe so you don't miss it.